Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome back to the Treasury Update podcast, Paul. It's good to have you back again.
Good to be here.
I am looking forward to today's ongoing discussion about returns. Today we're going to be talking about hurdle rate or required returns. Maybe you can give us a quick recap of the other topics that we spoke about, just the return on capital, return on equity, those types of things.
Yeah, absolutely. Our prior podcast, we talked about the return on capital and return of capital, the concept of companies will make capital investments internally within the organization to get a certain level of return that they require. We didn't talk about required returns, but we're going to talk about that today. And so they will deploy capital in new products, systems, people, perhaps mergers and acquisitions or something else to generate return. And once they've exhausted all of their options, then they return the capital. And so we talked about those concepts last time. There's return on capital, return on invested capital, return on equity. There's various concepts around return. And so today, I'd like to dive a little deeper into an internal company notion of return, typically called a hurdle rate, which is kind of what it sounds like. You know, there's a certain level that you have to get to or above in order to make an investment. And so we'll talk about what that means.
Yeah, so this concept of a hurdle rate, this is used in what situations? This is used for project work, general view of capital, or how would you describe how most companies are using this rate that you need to get over to make it worthwhile?
Yeah, it can be tied to a variety of things. So it could be project work, could be tied to something that generates a return based on investment in systems that make things more efficient, or people for generating more sales. It could be products. So you invest in the products or services that you distribute as a company that generate return. It could be mergers and acquisitions, meaning you have a corporate development team that goes out and looks for opportunities to dovetail certain products, services, or organizations, or reach distribution, something of that nature that would generate additional return to the organization.
Okay, so as we think about this hurdle rate, if we're looking at investing in a new line of business, is that something we look at a hurdle rate? We need to get over 15%, a 15% return rate, or it's not worth doing?
Yeah, I'll take one step back and then kind of take a step forward. So most people, when they look out in the markets at an organization, a company, if you go out to, we'll just make it real simple, go out to Yahoo Finance or Google Finance, and you look up a company, publicly traded company, you can get information on, the organization will have all kinds of different metrics. And one that is key that a lot of people look at is what's the return on equity. We talked about that when we talked about weighted average cost of capital. We also talked about it for return of capital. And so when you think about that level, let's say an organization has an ROE, return on equity, of 10%. If I am a CEO or president of a company and I'm looking at a line of business I want to buy, if I went out and said, hey guys, we got to get at least 10% because that's what our return on equity is. Well, that may not be a fair level to compensate for risks associated with integration and factors that are unknown to us about the organization. Even though we do due diligence on a company, it might not mean that we know everything once we acquire a company. What a lot of organizations will do, will say, hey, at a minimum, we have to get X percent. And so let's say you've used 15%, let's say it's 15%. So if I'm going to go out and do an acquisition of business that would be within my industry, something that I really know very well in terms of their product and service, 15% may be the right level for me. Now, there could be situations where we make an investment in an organization where we really don't know the industry very well that they're in, but they complement our company and what we do. And so we want to do an acquisition because complementary businesses could be very valuable. But we may apply a higher hurdle rate in that instance because there's risks that we just don't know about. So maybe it's 18%. And what happens in those instances is when you're looking at the cash flows that could potentially be generated by that organization by acquiring it, compared to the investment that you make upfront or post-acquisition, because sometimes there's payments you make post-acquisition, and you look at those cash flows and you apply a discount rate to those cash flows, in this case, 18%, you want to know are you going to have a net present value that's greater than zero? You're trying to beat zero, because if it was 18%, well, then the NPV would be zero, which would mean that your internal rate of return based on those cash flows would also be 18%, because that's what an IRR is. It's just a discount rate at which cash flows would equal zero when discounted. There's different ways you can approach those hurdle rates. So to say 15% is the only rate that you're going to use, I think is not always the best approach, because there may be other factors that impact the value of the organization you're looking to acquire.
So let's apply this to a couple other situations, or at least one other situation. You're putting in a system. Okay, so then maybe there's two aspects of this. You're putting in a system that helps you comply with regulations. So there's an aspect where it's required. How you do it, how much you spend may vary, right? You have to comply, but there's different ways of complying. So I guess one aspect when you're looking at a project, whether it's for compliance or it's just for efficiency, how would you distinguish between people talk about, hey, it's the ROI of a project and does it meet our hurdle rate? When you're looking at projects, how would you talk through those two different terms for evaluating, putting in a system?
Yeah, so it's a little bit different than what we talked about before. Putting in a system, there's a couple things that can come to mind. Systems can generate efficiencies in current processes that are being done. And so in the event that you have regulatory requirements or some other legal requirement that says, hey, you've got to comply with these particular codes or laws or regulations, you may have people that are currently working in roles or positions where they're working on the compliance factors. And it could be a very manual process. It could be something that's very time intensive. And there is a certain cost factor associated with that. So when you're looking at these projects, you try to look for ways that you can gain efficiencies either in the process or through reduced costs, reduced time, reduce full-time equivalencies or people's time, where you can redeploy those resources to something else because this takes less time. You're looking at a couple different factors combined together against the cost of doing something that you have to do. See, hey, can we meet or exceed the cost of doing this project over an extended period of time and save ourselves in terms of costs and efficiencies?
The idea that there's a hurdle or perhaps a standard hurdle rate. You provided some guidance as to, perhaps 15% might be the common rate. And if something's a little farther afield where you have to account for greater risk of realizing all those benefits, you might move it to 18%, or at least that's what I remember of your example there. Mm-hmm. How does having this standard hurdle rate help people in the company evaluate activities? Is this just a finance exercise, or is there something else that this provides a finance mindset to the company? How would this be useful?
Yeah, so typically when you talk about hurdle rates in of themselves, it's really a finance mechanism. Now, when it comes to evaluation, there's a lot of other factors that go into it. So the finance evaluation is one component, and it can be a very important component. And sometimes it can be the make or break decision on whether you go forward or not, depending on what the numbers tell you. The other things that come into play are more of the qualitative aspects of making a decision. So there can be qualitative aspects that are quite important because it could be that either a project or an investment in product or line of business or merger or acquisition positions the organization in an area that makes it better suited for success down the road. And that can have a lot of value that is not derived in the cash flows or the finance side of things when you're looking at those particular items. So qualitative aspects can make a difference and are important factors. Other things that you want to consider is, obviously impact on people, impact on resources, how you're going to be able to generate a product and service, how are you going to distribute that? You also want to think about, let's say it's an M&A transaction. What are the integration aspects associated with that? Are there factors that we haven't considered? You could go on all kinds of different things, but ignoring the qualitative aspects in addition to quantitative or the finance side of things, I think would be a mistake by companies.
Sure. So as we, think about this topic of required returns and draw the conversation to a close, anything else that we should know, or maybe you want to provide a summary of what's the purpose, and is there anything else that we should be contemplating for identifying or methods of identifying, what's an appropriate hurdle rate?
Yeah, so there's a couple other things that we didn't talk about that I'll just use as examples to kind of close out. So there are opportunities that organizations engage in where a particular product or service is very new to the industry and perhaps to the public. Or it could be something where it's super high risk. The chance of return or getting your capital back is low. The ability to sell off particular business or product may be relatively low, or it could be illiquid. In those instances where, let's say you're looking at a startup business or a business that's maybe at a point that they're going to do some mezzanine financing, which is they've got a product built and they're working on their next level to actually, establish themselves as a credible business. And in both these cases, you would look at factors around, what kind of track record do they have in place? Do you believe the management team? Do you believe the projections that they have? Do you believe that you're going to be able to get your money back? In the instance where you think, hey, I might not get my money back, you would apply some additional layers to your hurdle rate. So you could pump that hurdle rate to a point where it's 25, 30, 40, 50% for a discount rate or a hurdle rate in order to get your return because there's a higher level of risk. Those don't happen very often, and most likely the amount of funds that you would contribute to something like that are going to be a lot less than a company that you would use a 15% hurdle rate for. So two different things. One that's very early stage, something that's much more mature. You got the quantitative factors in both cases. You also have the qualitative factors in both cases, but a little bit different. Hurdle rates are important for decision making. They help you on the finance side, but you can't ignore the qualitative aspects.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.